All right. Hey, are we live? Woo! We are live. Oh my goodness. Are we live? Can they hear us? All right, we are live. All right. Welcome, everybody. Welcome, welcome, welcome. This is Budget for Success. Woo! And we are here live. We have a special guest. Yes, we do. So let's do some introductions. All right, Andy, take it away. Introduce yourself. There's Abigail.
Hello, good evening, everyone. My name is Andy Cortez. I am a wealth management advisor, and I am excited to join the call here today with Onyx. Just to give you a little bit about myself before we get started here on answering questions and sharing some information. I just want to let you know that I've been in finance now for 15 years, have been a licensed banker since 2016. And have been a financial advisor now since 2020, have worked for 4 different financial institutions. And again, I'm really excited to get to the meat and potatoes of this conversation and answer any questions that you guys may have.
All right. Woo! And we have Big Daddies in the house.
Hey, everybody.
Hey,
Glad
Big
to
Daddy.
be here. It's time. It's time.
Yes, let's make this money. Okay, so we have Abigail here tonight. We got Mindy, Choose to Shine is here. Welcome, guys. Welcome. So we are really excited to have this opportunity to have Andy here with us. So my husband and I have been working with Andy now for several months. And let's just say that he's done good work for us.
Yes, he has.
And
yes, good things.
And we do exactly what I shared with you guys. What good tips to do is you sit down with your financial advisor on a monthly basis and you get feedback from them and you find out what's working well, what's not, what's going on that you should know about, what are some new investment opportunities. I mean, tons of questions that you can sit down and ask your financial advisor. So now tonight, you guys get to ask Andy questions. Woo! So we got some Q&A we're going to go through, but if you have questions, we're going to send you a link and you can click on the link and we can bring you to the stage so you can ask Andy some questions. All right. So our first question of the night, let's see, what's our first question? What are the different type of investment accounts that we could look at doing for retirement? This would be like at our level that we can understand.
Absolutely. So the first option is a self-directed investing account. So self-directed investing account is where you can log into really most financial institutions or your primary bank, and you can open up an investment account either on the online banking platform or even on the mobile platform. But you can go on and open an individual brokerage account on that self-directed platform. Also, you can do a full service brokerage account where you get the opportunity to work with a wealth management advisor like myself. You can also move forward with a managed account and of course 401ks. And if you've heard of annuities in the past, those are also other type of retirement investment accounts that you can establish.
Awesome. Any questions, guys? So I know I initially started off with retirement account through my job. But then as time went on, I learned about different options, right? So I learned about a Roth IRA and I was like, oh, okay. So there's one you can do pre-tax and there's one that you can do that's, after you've already paid taxes and you just want to put the money in. And so I started a Roth IRA. And then as I left the job, I was like, well, what do I do with the money? And so when that happens, what should an employee do if they leave one job and say they go to a different job, what should they do, Andy, with that money?
So you have a couple of options, right? When you do leave your previous employer, most employers have I would call it kind of like a holding company, right? One of the more popular companies is Empower. So they're typically the ones that are holding the retirement accounts for these companies. And so what you can do when you leave your employer is first, when you get to your next employer, is ask them if they do offer a 401k and if you can roll over your previous employer 401k to them first. And the reason I say that is because typically your 401ks have lower expenses for you. Or you can also meet with a financial advisor and have a discussion around what you like to do with those retirement assets. And if you decide that you like to roll those assets over to a retirement account, you can either establish that retirement account on your own, again, a self-directed IRA or a self-directed Roth, or you can work with a financial advisor and establish either a managed account, a brokerage account, or some sort of investment vehicle that allows you to transfer those retirement assets into a new retirement account.
Awesome. Yeah, I know that comes up a lot. People go, what do I do? What do I do? And so my husband, he's self-employed.
Mhm.
And so how has that worked for you for retirement?
Well, depending on the bank, now that we are with the bank that we are with, it's pretty simple. It's pretty simple. Right from my mobile app, I can control things. I can look and see exactly what's there. When things are rising, I get to see it real time. So it's on my phone. So I don't have to make a phone call. I just open my app and look like just at my accounts. So
yeah, that's important. Kay so blessed. Hi, Kay. Yeah, that's really important, guys. We tend to look at our checking account all the time, right? Because we're budgeters, so we check our checking account. But we should also look at our retirement account. This is our money, and what you value, it will grow. And so you should be looking at it and managing it. And yes, sometimes it'll go down and it'll go back up, but you want to be aware of what it's doing and whether you need to call your advisor and say, should we make some changes? So the only way you're going to know that is if you get on that phone and you look it up and you see how your account is doing and how much money you're making. So excellent, excellent.
And
All
Onyx,
right.
I would like to just take a step back and say, what your options are with that retirement account. The first option, of course, is you can leave it with the company that it's currently with, because again, typically the expense ratios are a lot lower. The next option is maybe you need the funds and you can request those funds to be sent to you in a lump sum. However, keep in mind that most of those assets have not been taxed. So if you do request for it to be sent to you in a lump sum, you would have to pay taxes on the amount that you decide to withdraw. And that amount will also be added to your annual income in the year that you decide to take it. Or your other option, of course, is to roll it over to another institution.
Yeah. Yeah, I will say, guys, when we set up our money and we put it in different buckets, if it's in the retirement bucket, you need to really try to keep it in the retirement bucket. We have other envelopes that we set up for emergencies. We have envelopes we have set up for household. We have envelopes for car maintenance. There's Buddy. Hey, Buddy. Yes. And so if you have a money in your retirement bucket, you really need to leave it in the retirement bucket, because as Andy pointed out, if you take the money out, there's some negatives that go along with that. All right. So Mindy says, Roth IRA is confusing to me. Basically, the amount you have to add each year.
So with Roth IRAs, remember that what you're contributing to Roth IRAs is after tax dollars, right? And with Roth IRAs, essentially when you do decide to make a withdrawal once you retire, you won't have to pay any taxes on what you are withdrawing, because again, they're after tax dollars that you've contributed to the account. And specifically with a Roth, The maximum contribution to a Roth IRA in 2024 is $7,000 or $8,000 if you are 50 or older.
Okay. So 8,000 if you're 50 or over. So, and I did both, right? So both is also an option, guys, where you can have money that you put in pre-tax and you can put money in a Roth IRA post-tax. So that is an option too. All right, what is our next question? Is this it? What are the different types of retirement accounts?
So again, the different types of retirement accounts are traditional IRAs, Roth IRAs, SEP IRAs, simple IRAs, employer pension plans, 401ks, annuities, and even HSAs, which are health savings accounts.
All right, guys. So who put in the comments, what type of retirement accounts do you have through, do you have it through your job? Are you guys doing self-directed IRAs? Let us know. Tell us what you're doing for your retirement. Let us know so we can see in the comments, because this is for you. You have questions. We're here to answer these questions. Slim Bay is here from Texas. Woo! All right. Well, we're waiting for you guys to put the information. Oh, Veronica, she said she has a 401k through her employer. And what's it? Oh, a self-directed 401k. Okay. So she's got both. Smart. Nice. And then Slim Bay has a Roth IRA and a 401k and a taxable account. Okay. Good job, guys. So what is a simple IRA? She says, I have a 401k and a high yield savings. So what is a simple IRA?
So simple IRAs are typically for business owners and sometimes for their employees as well. So it's just another type of retirement account, different type of retirement registration, essentially.
Okay, gotcha.
And then as far as high yield savings accounts are sometimes offered through the banks, and they're just offering a higher rate of return. Typically, okay. The high yield savings account rate is a variable rate.
Yes, and there's a place for all these, right? There's like no right or wrong answer. You can put money in one or the other or both, right? All right, let's go on to our next question. We got that one. Okay, so what questions should we ask Andy if our job says they have a retirement plan? Are there certain questions we should go in asking about?
Absolutely. I've written down a couple here. There's definitely additional questions that you can ask, but these are the ones that I came up with specifically. One is, does your company match your contribution, and how much does it match, right? For example, some companies will match you up to 4%, or I've seen even up to 6%, where if you're contributing 6%, they'll match that 6% for you. So if you can definitely do 6%, I would say go ahead and do that, right? So that you can get that matched by your company. The more that you can contribute into your retirement account now, the more funding you'll have when you actually decide to retire. Also, is there a Roth option? So personally, with my 401k, I do have a traditional portion to my 401k, and I also have a Roth. So I'm saving pre-tax dollars and after-tax dollars. So I would recommend that you ask your employer the same. Do they also offer a Roth? And then what is the maximum that you can contribute per year? What are the investment options? What are the fees and expense ratios? And how long does it take to be vested in the plan?
Yeah, that's a good one. So when you say they have all these different investment options, but I don't know investments. Yeah. So what do I do? Like what's an intelligent question to ask the advisor at that job to help you decide what investment options you can, make decisions between.
So I wouldn't necessarily just say questions, but I would say more so, sharing what your goals, objectives, time horizon, and risk tolerance is with that advisor, right? Based
Okay.
upon what you share with the advisor would then be able to give you a much better recommendation as far as to what type of investment to, place your money into, or specifically what, type of allocation you should have. And by allocation, I mean, how much stock exposure should you have? How much bond exposure should you have? And so just being transparent with the advisor and say, I'm looking for growth, or I'm looking for income, or I really cannot tolerate any volatility. I'm really risk averse, or you know what, I'm looking for growth and I have a very aggressive risk tolerance. So sharing that with the advisor will allow him to give you a much better recommendation, and one that actually fits your needs and aligns with your goals and objectives.
Got you. So you're telling them your goals, like I want to retire in so many years, right? And then you're also telling them, but I want to be aggressive. Or you're like, look, I'm not trying to lose any money. So my risk tolerance is very low. So you put me in safe stuff. Or you say, I'm somewhere in the middle. Like I want to make some money, but I don't want to risk it all, right? So you're saying that we should explain that so they can help us put it in the right mix.
Correct.
Yeah, sounds good. So Veronica has a question. Can you tell me more about HSA and where do you get one? And what are the qualifications? I know that, Veronica. Veronica's like, give me all the details.
So for the most part, health savings accounts are usually offered through your employer, and a health savings account allows you to get a bit of a tax break depending on how much you contribute to your health savings account. But more importantly, that health savings account, what it helps you with is it allows you to be able to pay for, some of those medical emergencies that you may have, and you don't have to tap into your, personal savings account or checking account. If you have money that you can use in your HSA, and if your HSA money is actually being invested for you, the good thing is that you don't have to pay any taxes on when you use those funds, right? And typically with an HSA, they'll give you a debit card. And so when you go pay for a prescription, or when you have a co-payment at the doctor's office, you can use your health savings account debit card.
Yep.
So a health savings account then, guys, sounds like it's something where it's a good investment because you can put money in and it'll earn money. And you put it in pre-tax. Is it pre-tax money?
Pre-tax.
So it goes in pre-tax and it's going to earn money. And it sounds like it's easy to use when you want to use it for medical expenses, because you could even
Correct.
use it with a card. So that's a good deal. Yes. Hey, Deborah. Deborah's Journey. She's in the house. She's on the road, but she's listening. She says she's getting this good information. So I hope that answered your question, Veronica, about a health savings account. So I would start asking with your employer. Yeah. Oh, are there benefits of having a health savings account outside of your employer?
Yes, one of the major benefit would be that, again, you do get a bit of a tax break depending on how much you contribute to that health savings account.
So you could set one up if you just go to a bank and say, hey, can you help me with this? Or where do you go to set one up?
Not every financial institution will offer a health savings account. So I'm going to have to defer to Google and say, go on Google and see which financial institutions specifically offer those health savings accounts. Because again, not every bank offers it.
Awesome. That's actually given us some ideas, huh?
Yes, it is.
All right. So anybody else have any questions? So, hey guys, we put a link in the comments. So if you want to come on the stage and talk to Andy, feel free to click on the link so you can come on the stage. All right. So check out the link in the comments. All right. So we're going to go to our next question, which is, we're a brand new investor. So what advice can you give us before we decide to invest? And what are the first few steps to take?
So again, couple of steps that I came up with, and couple of answers here for you is first, I would say educate yourself about investing through individual research, right? Just try to do as much research as you can on your own. Again, Google could be your best friend when it comes to learning about investments. But then after you've educated yourself on investments and feel a little bit more comfortable and know what questions to ask, I'd schedule an appointment with a financial advisor to get additional investment education. Also, meet with a few financial advisors from different financial institutions, right? Not necessarily shopping around, but more so get an idea of what a different advisor's perspective is and see if that changes depending on what institution you go to. But I would say meet with a couple of different advisors and learn as much as you can from each one of them individually. But more importantly, right, as Onyx likes to do best, budget your money, right? Come up with a strategy and say, how much can I actually invest? How much can I actually afford to invest? Because when it comes to investing, you don't need to have millions of dollars. You don't need to have even hundreds of thousands of dollars. You can start an investment account with most financial institutions with as little as, I believe, $100 on a self-directed platform. So you don't need a ton of money to get invested. So I would say really budget yourself. Ask yourself, how much do I need in my checking account to be able to operate, to have a cushion, to be able to pay my daily expenses? And then have your reserve cash, right? Your expenses for 6 months to a year. And then the excess cash that you have left over, I would say that's the dollar amount that you can consider potentially getting invested. And then more importantly, identify your risk tolerance. Are you a conservative investor? Are you an aggressive investor? Your investment time horizon, right? How long do you want to be invested for? Is this money for your retirement? Is this money to pay for a child's education? Is this money to pay for a wedding? Is this money to purchase a home? So how long is it? What's your investment time horizon? How soon before you need to tap into these funds? Next is, what's your investment objective? What's your goal? Are you looking for growth? Are you looking for income? And then what's that investment amount? Decide, is it $100? Is it $1,000? Is it $100,000? Whatever you feel comfortable and confident investing, that's the dollar amount that you should come up with.
All right. Thank you. That's awesome. All right, Deborah's journey. She said, I'm at a red light. I have a question. Go ahead, Deborah. She said, what should I do with the 401k from a previous employer? Should I transfer to an IRA account? Because right now I'm not contributing any money to it. So that's key. Yeah, you want to keep adding money to it. So what do you think, Andy? There's Mindy. Yay, Mindy. Woo!
So
all right, we got Mindy on the stage, but let's answer Deborah's question first, and then we let Mindy go.
Yes. So Deborah, you actually have some options. Your first option is to leave your 401k where it's currently at. And you can call into the service center and ask them if they have a financial advisor or somebody that can assist you with changing your investment allocation. So I would reach out to them first. And the reason I would reach out to them first is because, again, you may have a lower expense ratio where you're currently at. That would be option number one. Option number two is if you need the funds and you like to withdraw the funds, you definitely can. Just be aware that there are some tax implications. You will have to pay taxes on what you take out, and what you do take out gets added to your income in the year that you decide to take it out. Your next option is to get the most recent statement, schedule an appointment with a financial advisor, have that financial advisor review the statement for you, and let him or her share with you what they could potentially do for you. And then ultimately, it's up to you to decide if you prefer to leave it where it's at, or if you like to manage the assets yourself, or if you like the advisor that you met with and want to continue to work with them, then they can proceed with opening an account, and you can have that 401k rolled over into that new IRA account that you're establishing.
Yeah, because if you leave it, are you allowed to contribute to it if you keep it? Typically not, right? When you leave it.
Yeah, typically not. So if you want to continue to contribute to it, I would say either move it over to a self-directed account or move it over to a different financial institution where you can work with a financial advisor.
Awesome. Yeah. All right. Well, let's go to Mindy. Mindy's in the house.
Hey, I'm going to back it up a little bit to my question on the Roth IRA.
Yes.
Like you say, the max amount is like 7,000 to 8,000. What if you can't contribute that much? Is there like lower?
You can contribute any dollar amount to your Roth at any given time. It's just the maximum that you can contribute if you are under 50 would be 7,000 per year. And if you're over 50, the maximum would be 8,000. But there isn't a minimum that you can contribute. If you're contributing $50 or $100, that's absolutely fine. You just can't exceed the maximum amount.
Okay, because I was always confused about that. I thought you had to like at least start off with thousands and
No. And actually, again, you can open up a self-directed account online. Different financial institutions have different minimums, but I want to say that you can establish a traditional IRA or a Roth with as little as, I believe, $50.
Yes, say it, because we have been led to believe you got to have $1,000, or if you want to work with a financial advisor, you got to have $100K. And
Right.
so it discourages us from, going to even talk to someone. And I encourage them. I said, go to your bank and tell them you're thinking about moving some money over, but don't tell them how much, just so you can get the information, because they act like they won't talk to you unless you've got like at least 50 grand in your pocket.
Right.
But you may have 50 grand one day and you want to know what to do with it. And so tell us, like, how can we approach advisors and get, help? Because even though we may not have all the money now, we may have it one day. Would you say, Mindy?
No, I said I was trying to moot you. Both sides, he wanted to be part of the conversation.
Onyx, you're spot on. I would definitely say, don't go into the meeting sharing too much information, right? Let the advisor do some work. Let us as advisors do the work and ask some questions, but I wouldn't necessarily share a dollar amount. I agree with Onyx. I would say, you know what, I'm considering bringing over some assets and I have some questions for you, right? Ultimately, I don't feel like you're cheating the advisor by not telling them. It's more important that you get the information that you're looking for. And ultimately, as advisors, we do have a fiduciary responsibility towards our clients and have to do what's in their best interest. So I wouldn't share a dollar amount. I would just go in asking questions and say, I am considering rolling over some of my assets.
Yeah. And you heard a financial advisor say there are retirement accounts out there. You can start with as little as $50. So get on Google and find them and get started. Mindy, what were you going to say? Oh, no. Okay. I thought you were.
I was just shaking my head, yes.
Yeah.
Because, we've talked and it's like, with retirement, I didn't start it young. So here I am over 50, but I'm not saying no more. And to build that retirement.
That's right. It's never too late to start, right? It's never too late to start. Veronica, she Googling. She out there with some complicated questions. Veronica, what do you think about an SCIA? Come on, Veronica, come on, click on that link. You need to come on into the studio because you got all these questions. Okay, what do you think about an SCIA? You know what that is? I hope you know.
Veronica, I will be honest and say I think you have stumped me because I have not heard of an SCIA. However, I would be more than happy to do some research and get back to you on that answer through Onyx.
Yeah, Veronica's in there. She's like, I got some questions. Hi, Erin. Woo! Erin is in the house. And we got Mindy on the stage. So there is a link in here that you can click on. And there we go. Bunny said, I put in $50 every time I get paid. And it does add up. Trust me. Even if you are only work 7 more years or 6 more years, if you don't start, you won't have anything. So just get started. The other thing that I found, and now I've been talking to Mindy about this, you may be doing only $50 now, but next year you may be able to do more, right? As you get debt paid off, as you get a promotion or you start a business and you start getting extra income coming in, you never know when you'll be able to add to that $50. So it may be $70 next year, $100, and that all adds up.
So
Yes, every deal counts. And I'd say when you start your 401k, again, contribute what you can. If that's 1% or 2% of your paycheck, do it. It adds up. You know, your retirement account, especially if you started at a young age, remember you can't touch that money until you're at least 59 and a half. So you have a long runway. And again, that adds up, and compounding interest makes a difference.
Yes, compound interest for sure. And then, okay, so what were you going to say, Mindy?
so which is better, a high yield savings or a Roth?
Well, they're two different things, right? A high yield savings account is just a type of savings account that'll give you a higher yield. A Roth is just a type of account. So just because you establish a Roth doesn't necessarily mean that you're earning interest or that the money is invested. You can open up a Roth brokerage account and deposit into that brokerage account, but that money isn't invested until you actually decide what to invest it in, like a mutual fund or an individual stock or an individual bond or some sort of managed account. So a Roth is just a type of retirement registration.
So you may not get a higher interest rate, but the thing with the Roth is you're putting into it with after the tax money, and technically you should not pull that money before, retirement age, so that it's available to you, when you retire.
Right.
Versus a high yield savings account that you can tap into all the time. Then he said, no. We don't touch the high yield savings. We leave it alone. That's good. Yes. All right. So Veronica came back and said SCIA is a secure compound interest account.
A secure compound interest account. Don't know what they mean by secure, but compound interest account, I mean, that would be like a savings account or a money market account where, it's generating interest for you on a monthly basis or sometimes on a daily basis. And then that interest just gets credited to your principal balance so that you can continue to compound interest and try to generate more month over month.
Now, one way you could secure your money is if you do a CD, right? Tell us about CDs.
Yes. So CDs are banking products. So CDs will give you FDIC insurance, and CDs in most cases will give you a fixed rate of return for the selected term, right? Some institutions have CDs for 1 month all the way up to maybe 13 months or longer. So CDs are definitely a secure banking account. Where, again, you do have that FDIC insurance and you're earning a fixed rate of return.
Got it. Oh, I see. Now, Veronica came back using, is that a universal life stuff, IUL?
Yeah.
Is that an insurance? That's a type of insurance plan?
Correct.
But you don't deal with those types, right? Because you're not in insurance.
So I actually do have the ability to do insurance products as well.
Oh, okay. All right. Well, y'all heard it. So if you need some more information, you guys get in touch with me and I can connect you with Andy. So definitely get in touch with me. Beautiful Budgets is in the house. Woo! Hello. Thank you. So what would be the steps that a new investor should take? Andy, I shared with you my experience where I went to the bank and they were like, here's the investment advisor. And he was just like, you just don't have enough money to really talk to me. So you need to go get some more money. I mean, what advice can you give us? Because sometimes it's scary to step into the bank and ask for an investment advisor.
Well, one, I'd go back to one of the earlier questions where I definitely recommend that you try to educate yourself as much as you possibly can first. Write down a couple of questions. If you don't know what a certain type of investment account is or a certain asset class is, just write down the question and ask that advisor. But something that I would consider when picking an advisor to work with is the advisor's experience. Do they have any professional designation? Do they specialize in something specific when it comes to investing? Their level of professionalism, their communication style and frequency of communication, responsiveness, and then of course, the fees. How much are they going to charge you for their services?
Yeah, fees are important. Hun, share your experience or your thoughts on, picking the right advisor.
Well, we did explore a few different advisors before we connected with Andy. I think educating yourself, like Andy was saying, that's critically important. That way you speak with more confidence and be more assertive about what you're asking for, and versus do not go in the door expecting them to advise you without you having some wisdom. You need to have some arm yourself before you walk through the door. That way you can engage on more of a level of where they might be at versus I know nothing, tell me what I need to know. No one wants to do that. That's not an even playing field of communicating. One thing I'm really happy about today is we are opening the door and we're lifting the veil so that people can see the real deal, and all this myth stuff like Mindy was talking about how much you have to have up front. No, it's easy. It's available to everybody.
Yeah.
And as long as you know it's available to you, that is a confidence level that allows you to walk through the door and to know that you are somebody,
right,
and that your money matters.
Amen. Yes.
So
your money matters. That's right. And it may be 1,000 today, but it could be 10,000 tomorrow. They don't know. So you going in there saying, my money matters, and I need you to matter to me so we can get this thing going.
The sooner you start, the more momentum you will gain. The earlier you start, obviously, is the better. So the earliest you can start is today.
Yes, today.
Right. And to piggyback on what Mr. Jones is saying, he's right. It's something that we normally say. It's not about timing the market. It's about time in the market. Yes. So there's no way to time it. We don't have, myself as an advisor or any other advisor out there does not have a crystal ball to be able to predict when is the perfect time to invest. If we knew that, we'd all be rich. So understand that there's no way to time the market. It's just about, getting invested now. The sooner you're invested, the better it is for you.
Yeah. And I'll be fully transparent. When we first started investing with Andy, our investments did great. They were like, bam, oh, look at that. Woo. And then all of a sudden, but like the market crashed everywhere. And instead of panicking, I was like, I wrote a check. I was like, here, Andy, here's some more money. Because the market was down. I was like, we can get everything at a discount. So you can't time the market. I mean, it was just a great, perfect timing. We went in and our money shot up and it was great. But then months later, it went down. It just happens. That's how the market is. It's cyclical. But it's really how long you've been in the game and how long you've been putting money aside, and that money will grow and work for you. Okay, so we had a couple of good questions. The one on the screen, we're going to go back to Deborah. So Deborah says, when I retire, which I hope is in 4 years, go girl, woo, let's put it together, 4 years. How should I draw down my money? Oh, what a great question. She has a Roth IRA, and it sounds like, and a 401k. She just opened the IRA account. And she also has investments in stocks, and she has a pension. So
sound like she said.
yeah. So I know you've probably seen it done all different ways. There's probably no right or wrong answer, but what's some thoughts about how to draw that money down?
So Deborah, I can't answer your question specifically, right? Because I don't want it to come off as if I'm giving you personal investment advice. But what I would recommend definitely is that you do meet with a financial advisor and they complete a retirement plan for you. But to kind of answer your question right now, if you are going to start drawing off of your retirement assets, I would personally start drawing off of your Roth account first, because remember, that's after tax dollars that you've contributed to it. And if you're withdrawing from it, you're also not being taxed for withdrawing from it. So it's not being added to your income in the year that you decide to start withdrawing from your Roth. So I would liquidate your Roth portion before you start tapping into your traditional IRA or 401k, because that portion you will be taxed on when you decide to make a withdrawal.
Great advice. And I will say also, Deborah, I treat my retirement funds just like, just like my budgeting, right? So I have a budget set up during retirement, and I only pull funds that I need, because I also want to make sure that those funds are going to be there for the longevity. And so when you budget while you work, you should budget when you retire. Don't go crazy because you got all this money available to you. I would keep continuing to budget because you want to have that money there for the long run. Yeah. Awesome. All right. So we got some more questions. Slim Bay says, what do you think about the robo-advisor accounts for people that are much more experienced? Has anybody ever invested in those accounts? They're interesting. Yeah, I'll tell you my experience, but I'll let Andy answer that question.
I absolutely do not like robo-advisors because of my job security. No, you know what? Having a robo-advisor, if you're not someone that is very knowledgeable when it comes to investing, and if you either have chosen to not work with an advisor, or maybe you've had a bad experience and you decided to go the robo-advisor route, I wouldn't necessarily say that that's a bad route, but understand that it's really a combination of, some of the AI technology that we have now. And just in my personal opinion, robo-advisors are very similar to investing in a target date fund within your 401k, right? So with a robo-advisor, they're going to ask you a couple of questions, the same questions that a financial advisor is going to ask you, which is your level of risk, your investment objective, and your time horizon. And then just based off of those questions alone, they're going to give you a recommendation of what to invest in. And it might just be a specific type of allocation based off of your risk tolerance. Mm-hmm. So it's not, you don't really get that personable approach. I'm not aware that any robo-advisors are doing any type of planning for you or any ongoing investment advice. It's more of like a set it and forget it type of account. But it is an option, and I do believe that it may work for some individuals, especially if you really just don't have time to manage your own investments.
So I opened up a robo-advisor account at one point. I think I was bored. I was during COVID. It was like, well, I should put some money here in Robinhood, I think it was. And so when the money wasn't doing well at all. And when I tried to call to talk to someone about it, they were like, well, you have one of those accounts where you don't get an advisor. So I couldn't talk to anybody. And they were like, yeah, no, this is not the account where you get that advice. And
so you couldn't talk to a person.
I couldn't talk to
a robo account.
I had some questions. My robo account was not doing well, and I had some questions about it. And they were like, "Yeah, no, that's not the account, lady. We don't talk to you. You just it's not an account that gives advice." So I think, it really is up to you. But I like what Slim Bay says. She said she started with it, but then she later rolled it to an advisor. And Slim Bay, that's exactly what I did. When they told me I couldn't talk to anybody, I said, but the account just keeps losing money. He said, well, ma'am, the market and blah, 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 blah. I said, you know what? Thank you very much, sir. And so that's when I was on my hunt to find an advisor, because I wanted to be able to talk to someone like, if it is down, let's talk about it. So Andy knows we went in to meet with him. I think we go every month or every other month. Every month. So when the money was down, we were like, let's talk, Andy. Let's talk about why the money went down. But it was still educational. It was enlightening, right?
Yes, absolutely. I would say, when your account balance goes down, right, or when it goes up and you receive that monthly statement in the mail, what you're getting there is simply the market value. When you invest in a mutual fund, or just really any type of investment, you're either purchasing a certain amount of stocks or you're purchasing a certain amount of shares. And when you invest, you pay a certain price per share or a certain price per stock. And what happens is the value of that stock or the value of that share either goes up in value or it goes down in value, right? It either goes up for more than what you paid to get in, or it goes down from what you initially paid to get in. So understand that that's just the market value. You're not really losing anything. I like to use an analogy as far as think of when you invest, you're purchasing a certain amount of marbles. Those marbles, you'll always have them in your hand. You won't lose a single one of those marbles. What's happening is the value of each one of those marbles is either going up or going down. Similarly, like if you own your home, or if you bought a home, or if you own a home in the past, right? If you purchased a home today for $1 million, and for whatever reason, the real estate goes down and now that home is worth $800,000, are you going to sell your home? Are you going to say, my home went down in value, so now let me sell it? No, you're going to do the opposite. You're going to say, let me hold on to my home. When the market value of my home goes back up to what I paid or more, then I may considering my home, but you still own the home. You still live in the home. So, why sell it? Same thing when it comes to investing. You still own the same amount of shares. It's just the value has gone up or the value has gone down. And also understand that you don't realize gains and losses until you actually decide to take the money out, because then you're either taking more than what you put in or you're taking out less than what you put in.
Gotcha.
Thank you for saying that, because I was running through my head. I know a lot of people were probably processing that thought. Like my wife was saying, when the market went down, that's when it's time to buy, to invest. Such as when your analogy about homes, if the home's prices went all the way down to the bottom, I'm going to buy some property because I know the price is going to come back up and the value is going to go back up, and that's a gain. So when the market goes down, it's time to buy more shares because those marbles gain value and they multiply.
Yeah, that's true. That is so true. So Mindy, tell us, what would be one reason you haven't actually gotten a financial advisor?
You don't have a good reason?
Is it because you haven't met me yet, Mindy?
No. I guess because, again, that I don't feel I have the money for an advisor yet.
So what do you say to people that don't feel like they have the money or they have enough money?
So I would say to get started first with maybe a self-directed account, reach out to somebody that has invested in the past, whether that be a friend or a family member, somebody that has experience or personal experience just investing on their own. Um, or you can go to a financial institution and just ask them directly, what are the minimums to work with a financial advisor? And what are the different type of platforms that you offer those investment accounts? Because as an example, there are financial institutions that have lower minimums and you can still work with a financial advisor. It's just that you might have to work with a financial advisor virtually, so either by phone or via, Zoom, because a lot of these advisors that do have a lower minimum are actually working out of like what we consider a hub or a call center. So there are advisors out there that can take on lower minimums. So I would just do some research, go into different financial institutions and just say, what's the minimum to work with your advisor? Or do you have another department where I can reach out to an advisor and work with them?
Yeah. So you really never know until you ask, right?
Right.
Yeah.
My family wasn't one that invested or anything, so it's not like something I knew.
Right. Yep. And then sometimes we don't even understand the value of all that we have because we may think of only one account. But I know when I went to talk to Andy, we looked at all the accounts, not just one account. I was like, well, Andy, I have this one account. I want to move over. He was like, well, what else you got? Because some of us have retirements from other companies and we just let that money sit. We don't even remember that money's still there. So sometimes it's helpful to sit down with someone and pull all your resources together and just have a conversation. Like, what's the best avenue? What's the best step to take next? Someone did ask about high yield ETFs. Is there anything you could share about ETFs?
It says, what do you think about these introductions of the new super high yield ETFs offered by YieldMax?
Now that sounds like marketing right there, but let's talk about ETFs.
Specifically high yield ETFs, like new high yield ETFs that are out in the market. Again, I'd have to get back to you specifically about those, but just as far as ETFs in general, what an ETF is, if you don't know what an ETF is, it's just a basket of stocks or a basket of securities. Similarly, like to investing in like investing in a mutual fund where you get, diversification, where you have some bond exposure and you have some stock exposure. You can do that through ETFs as well. The difference being that ETFs trade similarly like stocks do. So you can sell out of an ETF or purchase an ETF on the same day versus mutual funds. Typically, in order to sell out of a mutual fund, it takes a couple of business days because the portfolio managers have to raise the amount of cash that you requested. So ETFs give you access to a basket of stocks and allows you to trade them like stocks do.
Yeah. And ETFs are good investments for beginning investors. I think now this is my personal opinion, because as Andy said, it's a basket of stocks. You're not just investing in Apple or Amazon, like one stock. You're investing in a whole basket. So if you're a new investor and that's something you want to explore, they have ones where you can invest on your own. There's platforms out there which you can invest on your own. Or you can also invest in those through your financial advisor as well, because they put a whole portfolio together for you. So, but it's definitely something that you should, as Andy said, research it. And then if you want to talk to a financial advisor, you can ask them specific questions about ETFs. All right, guys. Well, I think we've answered all the questions. Are there any other questions out there before we close out? We are just so appreciative for Andy to come out. As Bunny said, she is really appreciative that you came and spent your time with us and helped us, get more information. Yeah, Bunny said this was very helpful. And I'm so thankful as well, Andy, that number one, I'm thankful that You have been a great advisor to us, my husband and
Yes.
I.
Thank you very much.
We've learned a lot. We sit down and look at Andy every month like, what's new? So we learn something new every month. There's so many different types of investments out there, guys. I just encourage you to just keep asking questions and find that Andy for you. If you do have specific questions for Andy, send them to me and I'll connect you with him. And then, you know what, we're going to continue this conversation because I just think that is so important. That's why I have the Smart Money Tuesdays, is to get you guys to keep looking and searching for more information so that you can be more knowledgeable. Knowledge is power. Yes, you're welcome, Slim Bay.
Thank you all. It was very helpful.
Oh, good. Sassy asking about the gold bars. Should we invest in gold?
Gold is definitely one of the asset classes that you can invest in. Gold is a hedge, a hedge against inflation. So that's definitely one of the asset classes that you can invest in for sure. And you can either invest in, physical gold, or you can also invest in gold ETFs.
And ETFs, again, that's that whole basket, right? So you would have a whole basket of investments that are centered around gold. So there you go. Yes, choose to shine. You will be able to do the replay because you may want to pay it back and take some notes.
I think if you get anything from this live, if you play it back, however many number of times you do, get some confidence.
Yes.
Confidence within yourself to recognize the value of yourself, the value of your money, so you can invest it the right way.
Amen. I agree. And with that confidence, build your portfolio. If your goal is to one day hire a financial advisor, then don't lose your focus. Stay focused on that and grow your portfolio, and call that advisor up when you're ready and say, let's do this. It's worth it. Yeah, I really appreciate it. All of the knowledge that I've learned. Not only am I happy that the portfolio is doing well, but I'm also very happy of the knowledge that Andy has been willing to share with us in the short time that we've been working together. So it's definitely, I hope you guys build anything else from this is confidence. I agree. Yeah.
I'm even happy to see Andy every month. So I look forward to the meetings because he's a great guy.
Yes. So choose to shine. Reach out to me. I have my emails everywhere. You look on my channel and get my email address and send me an email, and I will connect you with Andy. All right. Oh, yes. Invest today for a better tomorrow. Thanks, Aaron. Absolutely.
Go.
Yep. And Mindy, you want to close out with anything?
Sorry, I'm muted again. No, but thank you all.
Thanks, Mindy. Thanks for coming on the stage with us, Mindy. Woo!
Andy, thank you, Andy.
Push that.
What did you say, Mindy?
I said it was hard to hit that link.
But you got it.
This has been wonderful. Andy, thank you very, very much for contributing and sharing a vast of knowledge. Thank you.
So honestly, thank you both for having me. I really do appreciate it. And thank you both for doing this, right? I think I've shared with you how passionate I am about being able to educate others about investing. And so I'm glad that there's someone, there's people like you that are doing this and are committing your time to helping others. And anyone that would like to speak with me individually, Onyx, you have my permission to share my contact information with them. And whether you decide to invest with me or not, or any little question that you may have, once she shares my contact information with you, feel free to email me or call me. You're not bothering me. You're not wasting my time. I'd be more than happy to answer any question that you have.
Wow, that's generous. Thank you.
Thank you, Andy.
Yes, thank you. All right, guys, we love you and appreciate you. Thank you so much for joining us on the live. yes, choose to shine, please get in touch with me so I can connect you guys. All right. I want you to have a wonderful and beautiful, blessed evening. Andy, again, thank you, thank you, thank you. Much appreciation.
Thank you.
Bye, guys. That's it. That's our
Bye.
time.
Bye, guys.
Bye.
Love you guys.
Love you guys.